only insure against objectively verifiable problems. So claims. Objectively verifiable means that's something that is very parametrically resolvable. For example, is the DeFi NAV or if is did the liquidation happen or not?
Let's say I've restaked a couple 100,000 in like ETH or some other asset, depending on the restaking provider I use. I want to earn extra yield on top of that, and Catalysis seems kind of interesting. How do I deposit into it, or how do I get access to the yield and the opportunity?
It's a huge market. The infrastructure is ready. The capital is ready. You, for your audience, 20 billion plus is restaked today. And that's mostly idle.
All the tens of billions that are still restaked with Eigenlayer, which all of like my DeFi friends and I were farming 1.5 years ago for the Eigenlayer airdrop, which for some went very well, for others not that much. So you have the capital available, and for many other DeFi applications, capital and liquidity is usually the bottleneck.
We decided why not just build a solution to fix this long-standing problem in DeFi, especially since institutions are coming on chain and we need for them to have a protection layer to be able to comfortably come along.
Welcome back to episode 40, the Odyssey podcast. Today we are joined by Abhi, who is the founder of Catalysis. Thanks a lot for joining. And yeah, this episode will dive deep into all things on-chain and DeFi insurance, why the whole sector has not picked up yet, and how Catalysis will hopefully fix that. Thanks a lot for joining, Abhi. How are you doing?
Thank you so much, Max, for bringing me on. I'm doing well, thank you, and even better now that I get to talk about something I love. So, again, thanks for bringing me on. Excited to jam on this today. It's 6:30 a.m. in New York City, and I'm pumped. So, let's do it.
Very nice. Maybe just to start out, could you tell the audience a little more about your background, how you ended up trying to build an improved version of DeFi insurance? What led you here?
Sure. Yeah. Happy to start with the background story about myself. I'm Abhi, I'm the founder and CEO at Catalysis. Been in the space since 2020. Came from a cryptography background, worked in ZK, worked across staking, I worked on Ethereum consensus layer, worked with companies like Netherminer and Obol, worked with a bunch of other staking providers as well. So my entire expertise and my experience has been in the past in the staking ecosystem. So last year is when I decided with my co-founder through that we should start something to solve some problem in the staking and restaking ecosystem. So that's where I realized that, well, restaking is going to the next evolution of staking, right? And Eigenlayer, Symbiotic, and a bunch of different protocols were coming up. Last year, we decided we try to find a problem, and we actually discovered one, which is, there are multiple restaking protocols, and for developers, it's very hard for them to have access to all economic security, all restake capital because it's fragmented. So we started building that. We raised a round last year and we started building. And the first product we built is called Catalysis Core, which is how we aggregate capital across Eigenlayer and Symbiotic. So that's something we did. Fast forward to today, we learned from the market about what the other things can be done with this billions in restake capital and realized that on-chain insurance can be done. It's missing. It's a huge market. The infrastructure is ready. The capital is ready. For your audience, 20 billion plus is restaked today. And that's mostly idle. So we can use that as underwriting capacity. So the capital is there. So you don't have to bootstrap that. The infrastructure is there since you can slash and redistribute and all those things on Eigenlayer and Symbiotic. So the infrastructure is there. We decided why not just build a solution to fix this long-standing problem in DeFi, especially since institutions are coming on chain and we need for them to have a protection layer to be able to comfortably come along. So that's the journey. That's how we started this entire process of discovery, talked to different teams, found out the right problem, and we're excited to be able to solve this. And yeah, that's kind of my journey.
It's interesting that you came to it from a initially, what do we do with restaked capital standpoint, not with, okay, there's a big issue with on-chain insurance. The past iterations, I think last cycle, Nexus Mutual was around. That was the larger one that I was familiar with. If I remember correctly, there have been some weird arbitrage mechanisms between the wrapped NXM and like it was kind of a very complex, hard to see through protocol, and yeah, it never picked up for mainstream usage. So just looking back, if you identified the insurance landscape for DeFi protocols, what were the limitations that you were seeing, and how does Catalysis aim to solve these?
Yeah, great question. Nexus Mutual is the kind of the only insurance provider or insurance platform that exists today from the last insurance cycle, I mean, and like ones from 2021. And of course, Nexus has a couple of problems with, again, the NXM tokens. Most of the problems stem from the NXM token and a bunch of other things. But I will just give you a general idea about the problems that existed back then and how we are trying to solve that and how the landscape is totally different today. So let me share some thoughts on that, right? The problems that we identified looking back into the last insurance cycle, I would say, and it had multiple problems, right? And I will just give you some numbers. One, all the insurance protocols, 4 years back, 5 years back, they had to bootstrap capacity. So the cost of capital was high. By bootstrapping capacity, I mean bootstrapping underwriting and underwriting capital. And that led to multiple different protocols coming up with fragmented liquidity. And each of these pools were really small, like 50 million, 100 million, or so. And what that led to is the second point. First, that each of these insurance protocols have really limited capacity of the covers that could underwrite. So very thin covers. Second, because of that, the premiums got expensive. So if there's a lot of demand, there's not supply, basic economics 101, the premiums get expensive. The third is that most of the risks were concentrated. So, when the Terra Luna and FTX things happen, all of that, the massive claims are triggered and it all wiped out multiple insurance protocol. Why? Because they were all insuring the smart contract risk, this very endogenous, very highly correlated risks. And at the time, DeFi ecosystem was not mature enough, right? We didn't understand risk, and there were a lot of hacks back then, if you remember. And we didn't have like the specialist companies like that exist today, like the likes of Gauntlet, the likes of Chaos Lab, Llama, all these big folks came out of that cycle. The ones that now understand DeFi is much better, have much better monitoring and things like that. That didn't exist before. So I would say just the DeFi risk cycle or the DeFi risk was not well understood. And the fourth one, which I'd say which is the biggest problem of all, I would say, is the consumer base back then was retail DeFi. By retail, I mean, it's just you and me trying to protect my $1 million or like a couple million in our positions, right? That doesn't work because the problem with retail is that they are not willing to pay for insurance. Or even if they want to pay less, right? So these are the problems that we identified. The market being small, the cover capacity being limited, expensive premiums. On a demand side, they want it, but they don't want to pay it. And in general, the risks were not well understood. Now let's fast forward this from 2021 to 2025, 4 years now from that. What has changed? First, the DeFi landscape is much more mature now, right? In terms of risk management, we can better understand what risks are, and there are like very specialist DeFi curators like Gauntlet, MEV Capital, RE7, Edge Capital, all those big folks, and also risk monitoring agencies as well. They've spun up. So the smart contract risk, or in general the DeFi risk, liquidations and whatnot, are very well understood. So that's a good sign because to insurance to thrive, you have to have first very robust risk frameworks, which is now started developing, which is great. The second is, and one of the biggest factors why this is going to work, and this didn't work in the past, is because this cycle of DeFi is all about institutions. It's all about institutions. Institutions are coming on chain, and the good fact about institutions is that they bring volume. They don't buy 10 million cover. They would likely buy 100 million cover or more. So the volume is insane, and they have appetite to pay. they're willing to pay, right? And they're being compliant and things like that. So this cycle of DeFi is institutional DeFi, which are willing to pay. So the game's different. And the last 2 points that I'm going to mention relates to restaking and why restaking became our forte to kind of bootstrap this entire solve this insurance game. Restake, there's 20 billion plus in restake capital, as was talking earlier in the conversation. There's 20 billion plus in restake capital that is actually lying idle across Eigenlayer, Symbiotic, Babylon, and Jito, and a bunch of other restaking protocols. And they're looking for yield. So that's that. So you don't have to bootstrap capital because capital is already bootstrapped. That's the third point. So you don't have to go around and do tokenomics like the NXM token or whatnot to kind of bootstrap capacity. You don't have to do that anymore because you already have blue chip assets like ETH, BTC, Sol, and its derivatives lying across that you can readily use for. So capacity bootstrapping is not a problem. And the fourth point is about the restaking infrastructure, the staking infrastructure, we'll call it, provides you with these tools of where you can actually slash assets. They have what we call slashing, which is very perfect for which is kind of very apt for us in terms of if you want to do claims, we can just slash assets from Eigen or Symbiotic and put it back as claims to the affected party, right? So we can already use the things that we already built, and this are all live on mainnet and used by multiple people, multiple aliases, so that we can use the slashing primitive by restaking. So you don't have to really build anything from scratch. You can lock capital and can slash it. You can redistribute it. So you can take that capital from Eigen Vault and distribute it to as claims. You can use rewards primitive, which is again, rewards and restaking is what premiums are for, or fees are from policyholders. So in general, what I'm saying is restaking provided us with the capital. Restaking provided us with the infrastructure, the coordination infrastructure to build on top of. And the demand's already here, the institutional demand. They're willing to pay. It's just about how do we connect this joints and these 2 points about the demand and supply and make it institutional grade, compliant, and just make it a very seamless process so that no one understands what's going on the restaking side, no one understands what's going on the insurance side, and just connecting everything. That's why
So
it would work,
maybe
and
on
that's
that
why the
note,
landscape is different.
I mean, you already have the capital available. The capital is looking for yield. All the tens of billions that are still restaked with Eigenlayer, which all of my DeFi friends and I were farming 1.5 years ago for the Eigenlayer airdrop, which for some went very well, for others not that much. So you have the capital available, and for many other DeFi applications, capital and liquidity is usually the bottleneck. So could you dive a little deeper into your go-to-market approach? Who exactly are your counterparties? How do you sell them this solution, and how do they access it and integrate it into their DeFi flows? Like, just from a very naive perspective, let's say I'm a vault curator. So maybe I'm within your target customer group, and my strategies in the vault are obviously dynamic. So my risk exposure and my risk tolerance has to change over time because I adapted to current market opportunities. Maybe I deploy into new protocols which are not as battle tested. So how does the pricing work, and how do you sell your customers your solution?
Great question. Yeah, on the counterparty, we are only selling to institutions. By institutions, I mean crypto native institutions. Our initial go-to-market plan is to sell covers to different crypto native institutions, hedge funds, and DeFi curators, vault strategy, vaults, and things like that. So they are our customer bases. Now, how we get to them, imagine if there's Wintermute looking to borrow some credit, or it's like GSR doing some market making stuff, and a bunch of different crypto institutions that they're looking for insurance. This is something that we cover. Now, we have identified 5 very specific niche verticals where we can provide insurance. And by the way, by way of this, I would just start by saying that we do not cover smart contract risks. And that's the very unique thing about us. We are not a general insurance platform. We don't do smart contract insurance. We don't do like hacks. We do not do like intra bridge hacks and things like that. So what we do are a couple of things. One, we provide institutional credit risk insurance. So let's say if there's, as I was giving you an example, if Intermute buys gets credit of 100 million from Maple and they default, we cover the risk for that. We foot the bill. So we do the first of the go-to-market vertical is institutional credit risk, and it all applies for both crypto native and TradFi institutions. The second is stablecoin principal protection. So we enable any stablecoin holder to buy both principal protection and in future also DPEG protection if they need, and to hedge their positions across like loss of capital when when strategies underlying the stablecoin goes bust. So that's one. Institutional credit risk first. The second is stablecoin principal protection. The third is very interesting for DeFi is we enable instant liquidity as a service for DeFi vaults. So that's our third go-to-market vertical. So, you have different DeFi. In DeFi, you have multiple different vaults. Each vault, let's say it is $100, 10 to 15% of that is mostly reserved for withdrawals, right? And the rest is deployed in strategies, very roughly speaking. So what we do is essentially we enable these different vaults to plug into Catalysis as a hook, and they can withdraw instant liquidity whenever they want in return for a price. So they pay a fixed premium, and when there is an event of like liquidity crunch where like more withdrawals come in, for example, with more withdrawals coming than what the reserve ratio or what the vault has reserves in, they can instantly plug in Catalysis. So that's the third and very interesting use case for us. And the fourth one is asset custody risks. So this is very simple anchorage digital kind of stuff where we protect against theft, and asset custody things. And the fifth go-to-market vertical for us is providing real-world risk insurance. We're working with a couple of companies, including like Sunerium Labs, Spice Protocol. Sunerium is doing solar energy infrastructure insurance across New York City and a bunch of other places like South Africa. And they're tapping into digital assets for insurance. So that's like off-chain assets, including off-chain assets. The second one is Spice Protocol that is doing really cool stuff with invoice financing across cross-chain, cross-border deals. For example, iron mine, like iron exports from Chile to Peru, or across countries, they are doing that as well. So all in all, multiple different verticals, but it's not it's not an insurance that people think about. It's not insurance that Nexus provides or any other provider. It's very focused on institutional and DeFi vaults, and frankly, there's no retail involved so far. And we do across institutional credit risk, stablecoin principal protection, liquidity risk for DeFi vaults, asset custody, and real-world asset risks.
So let's assume that I'm a Protail DeFi user running my own book. I deposit into a vault, let's say by MEV, RE7, or maybe like Stream Finance. And of course, out of the entire risk assessment from a holistic perspective, the entire smart contract exploit and execution risks of the vault curators and vault managers, maybe messing up some bridge transaction or sending funds to a wrong wallet address. I obviously have to calculate that into my risk tolerance and into the expected yield in return. So given that Catalysis does not insure against smart contract risks, how do I, as an end user, or also as an institution, which is now not like a vault curator, now not insured against some of these execution risks and technical risks, like how do I still end up being able to holistically assess the overall risk?
Yeah, it all depends on what are the risk verticals that we want to cover, right? Risk management, you can do all kinds of risk management across like in smart contract risk, you can do institutional financial due diligence risk, their strategies that they run and things like that. So it becomes very messy when you try to do like a 360-degree holistic risk management for institution. So let's say, for example, as an institution, you put like $50 million or $100 million in a DeFi vault as a TradFi family office or whatnot. And if something goes wrong, with smart contract or other things, we do not protect against that. But we don't even like for this example, we don't even provide that kind of cover yet. We are not like we don't understand the exact risk yet, so we probably don't want to provide that. But for institutions that are, let's say, borrowing from this credit protocols, or yeah, let's say from lending protocols, we assess the risk not of the underlying smart contract platform or the lending protocol, the DeFi protocol. We assess the risk of the borrower or the institution, um, and say that, well, as an MMU capital, you can do a bunch of things. You can, you can run strategies. You can lose money. You can make money. I cannot really assess risk of what you are doing. So we do not insure your strategies. We do not insure your specific things that your specific strategies. Uh, and frankly, most of them don't won't even reveal their strategies. So that's also
Mm.
private for them.
Yeah.
So we're not insuring against that. We're just insuring against the reputation and insuring against the reputation and the risk of the institutional borrower or the institutional play here. Uh, and yeah, that's kind of them. So we do like off-chain due diligence as well. We leverage some of the third-party services to do a financial due diligence on the financial statements. For these institutions, we leverage on-chain solutions. We're working with Hypernative on that to do on-chain risk management and risk analysis, and we kind of put everything together and just create a nice assessment report and do a risk pricing with that. So the risk pricing comes up from due diligence on off-chain and on-chain risk, but that doesn't include anything about the DeFi protocol, because we're not insuring the DeFi protocol. We're insuring the institution who's interacting with the protocol. If that makes sense. So you're kind of shifting
Yeah.
the focus from the protocol to the end user.
Are you able to dive a little deeper into how you quantify the different risks specifically? Like, how do you assess the overall risk score, and how does that translate into pricing the risk?
Yeah, sure. I mean, to better answer this question, I have to let me explain a bit about how Catalysis architecture works, right? So for the audience and yourself as well, Catalysis is split into multiple cover pools. So each cover pool is dedicated to serve a very specific risk vertical. So one cover pool might just do risk management and underwriting for institutional credit risk. The second cover pool that probably does just underwriting for stablecoin dependents, and so on and so forth. You get the point. Each of these cover pools has what we call a cover pool curator. These are not DeFi curators, but these are cover pool curators. There are some cover pools that we own as Catalysis, and we kind of are applying for a Bermuda license. So we're going to be licensed like as a registered uh, cover pool license entity. And there's some other cover pools that are managed by other people, other companies like exactly, thanks for being in the submax. So there are some cover pools that we manage, and there are cover pools that the third parties manage, like Spice and Sunarium. Um, so the way we quantify this risk is very specific. So for one cover pool, if there's a cover pool curator like us, what we do is um, as I was mentioning, if an institution comes to us and say like, let's say Amber Grove Fast and Initial comes to us and says, that, hey, we are borrowing $100 million from Maple. Could you cover us for like, let's say 20 or $30 million for that? Could you become our second loss? And we say, cool, let us get back to you. And that's where we start um, getting their, doing a financial due diligence on their part, on the off-chain side of things, and like financial disclosures and whatnot. And on the on-chain side of things, we start looking into, how risky their strategies were. And then we populate a set of 10, 15 risk parameters, like different mathematical parameters. We populate those parameters and then input into our equation, the insurance equation that we have. And then the output of that is a range of premiums that is quantifiable. So we get a premium like, let's say 3 to 5%. That's the range that we think is the right pricing for this risk. That's how we quantify risk for a different risk vertical. Um, Yeah, that's the answer to this question. Uh, I will just make a note of it that this is how we quantify the risk, and this is how the premiums are priced. But it doesn't mean that premiums would be what ultimately get finalized. So the premiums are actually suggestive, the ones that we propose, and the rest depend on the market, like market equilibrium. For example, if someone um, like if we propose 5% as like a premiums for a specific institution, the risk takers might say, no, this is too risky. We will say 6%. And then the institution ends up saying, like, yeah, okay, cool, we'll do 6%. So again, it's market driven, but what we do is we try to price the risk to the best of our abilities to just have an initial anchor to the entire risk management process. And we do this for
Yeah.
each cover pool.
So just to maybe dive a little deeper into the architecture and flows behind Catalysis. So let's say I've restaked a couple 100,000 in like ETH or some other asset, depending on the restaking provider I use. I want to earn extra yield on top of that, and Catalysis seems kind of interesting. How do I deposit into it, or like how do I get access to the yield and the opportunity? And could you estimate roughly how much yield is there up for grabs depending on the coverage pool you're willing to deposit into?
Yeah, good question. On the Yeah, as an end depositor, if you're looking to get sustainable real yields, you can deposit your capital. Maybe let's say it's 100 grand of ETH. You can deposit it on a specific symbiotic vault, and there are multiple symbiotic vaults on symbiotic platform managed by different curators like Gauntlet, and maybe capital you can put in one of those vaults, or you can deposit in LRT like Renzo or EtherFi on the Eigenlayer side of things. Um, that is something that you can do, and it will be the responsibility of this these LRTs and vault creators to actually delegate to us and earn the insurance premiums as fees. Now, but if you want to go solo, right, you can easily deposit it into Eigenlayer or Symbiotic as an individual vault, and you can simply opt into Catalysis. So by opting, for those who aren't familiar with restaking, in restaking, what you can do is you can put up capital, you can deposit your ETH into this platforms, and then you have an option to delegate, to choose which network should I, or which AVS, which application should I delegate point my capital to, and so there's some technical things there, and then basically you end up being allocating directing your capital to Catalysis. That's as simple as that. The restaking protocol provides you a way to do that. So once you like delegate capital to Catalysis, you can also choose which cover pools you want to delegate to. Um, Roughly, like that's how. First of all, the first part of the answer is that's how you can opt into Catalysis and opt into the opportunity that we provide as insurance premium. Now, how much you can earn, the second part, it all roughly depends on like what your risk appetite is. As you can see, each cover pool is a different risk vertical, right? And each has its own risk reward portfolios. Each has its own like yield parameters. So all you can do is you can choose which ones make sense more sense for you. Maybe you can do conservative like RWA sync, or maybe you might get more risky. You can delegate to a risky cover pool, like doing smart contract insurance, for example. Um, all in all, there's a wide variety of yields that you can earn. It might be it starts from like 3.5% to all the way to 8%. So there's a huge range that you can get, but all depending on risk and reward ratios, and it's like again portfolio diversification thing. But again,
Which
it's
assets are
not
you able to earn yield on right now? Is it all priced in stable coins and stablecoin yield, or can you earn yield on ETH, BTC? I think especially for BTC, since the yield landscape there has been historically very dry, that would be a very interesting opportunity.
100%. By the way, the 3.5 to 8%, the numbers, the range I was talking about was in dollar denominated returns.
Oh, okay.
Yeah, and so Essentially, all blue chip assets are supported by this platform. So we support, for Catalysis, we only are supporting blue chip assets, which means Ethereum, Bitcoin, uh, Sol, and other blue chip stable coins like Ethena and others. By ETH, I mean ETH and ETH derivatives like wrapped staked ETH and staked ETH. For BTC again, you have like BTC and BTC derivatives that we support. So these are the blue chip assets that we support, and they can earn yield with Catalysis. Um, but by way of that, I can also share that I also saw a post yesterday where uh, BDC, Lombard partnered with Symbiotic to bring Lombard BDC to Symbiotic uh, to earn yields on top of LBTC on Symbiotic network. So we are also live on network. So they have not delegated to us, but the point being that's how you can earn. So you can put your LBTC into Symbiotic or EigenLayer, and you can delegate to us, and kind of earn yields on top of that.
Could you explain a little bit who are your current users, customer base? Like, which one of these risk pools, types of risks to cover, has gained the most amount of interest and usage so far?
Yeah, I mean, we're in advanced discussion with most of different folks. The market where we're getting more traction on is the institutional credit market. It seems like credit is booming, and it's inefficient today. From like the likes of Aave and Morpho, people want less collateral ratio. They want more LTV. So that's where like the covered lending cover pool, the covered lending market is where we're getting a lot of traction on. Um, Apart from that, we are seeing huge interest in the instant liquidity function. Like as I was mentioning, DeFi vaults and the instant liquidity as a service, that is also getting a lot of traction. Apart from that, the last market about RWA protocols looking to work with us to underwrite different RWA risks. This is also going to be very interesting. The likes of like Spice, Sunadium, and even we're working in an early discussion with Plume to do something on that side. Who exactly our customer base is? Our customer bases are not DeFi protocols. Just to clarify, DeFi protocols for us act as more distribution channels. They act as distribution channels because most of the institutions actually interact with these platforms. So our goal is to have product integration with the likes of Morpho, Euler, and a couple of different DeFi protocols, and let institutions come, and then we provide them cover from our pool, and try to make it. And our goal is to make the entire coverage infrastructure invisible. So even if a new institution comes to, let's say, Morpho market and say that, hey, we want cover, how do we do that? So they don't have to talk directly to us, and like we have to sell them a cover. Like, hey, you take a 100 page PDF policy. You can just opt into Morpho or like Euler, whichever market that we are integrated with, and you just get cover after whatever you want. So we're just trying to change the game on that side, and hence our customer base is actually the TradFi institution, and even insurers and non reinsurers who was looking to get into the on-chain insurance landscape, and also crypto native institutions, the market makers, the hedge funds, and liquid funds, and strategy managers. Those are our top initial market customer bases.
Are you able to share any numbers of the amount of capital you have roughly insured, and either like historical, current, your growth outlook, anything you want to share?
Yeah, I mean, I wish I could share numbers, but this is early stages. We are in the process of striking, striking these deals with different risk-taking providers on the underwriting capacity. So I cannot share numbers. The platform's not live on mainnet until Q1, so we'll go live in Q1, and that's where we can see actual numbers on a dashboard. But it definitely would be in the tens of millions in the risk capacity for sure.
Very nice. I think one last but very important topic segment is the entire resolution of markets and how decisions are made, whether a payout is valid or invalid. I'm not sure if there had been a lot of public disputes in the DeFi insurance sector in the past, but we've obviously seen, for example, on Polymarket, where you have real life events that are not happening on chain. You have an oracle. I think it's the UMA oracle that Polymarket uses. And over the past months, there have been several rather public and controversial disputes. So sooner or later, this will very likely happen in the DeFi insurance space as well. So maybe can you explain a little bit, how does your settlement, how does your resolution work, and which oracles are involved? How is the decision made, and what's the path to resolve disputes?
Yeah, Max, I think you bring a really, really interesting point to this discussion. Yeah, I would just start by saying that oracles are the backbone of everything on chain. I'm not even say DeFi markets, everything on chain. The truth on chain is determined by oracles. So yes, we have seen and in the poly market or Kalshi saying with UMA oracles, that was highly controversial for sure. And so the solution that we have found out to like circumvent this problem, at least to bootstrap our product or platform, is that we only insure against objectively verifiable problems. So claims. Objectively verifiable means that's something that is very parametrically resolvable. For example, is the DeFi NAV, or if is did the liquidation happen or not? Yes or no? It's as simple as that. Is the NAV less than 8%, 80%? Yes or no? So we most of the claims assessment that we have of the go-to-market strategies, we are relying more on objective verification rather than subjective verification. It's like, hey, was it hacked? Was it not hacked? Right? And hence, that's the reason we are not doing smart contract insurance today, because we are not able to solve this subjective verification problem. Like, did it really happen? Did it really happen? Or like, was it self-harm? There's a ton of other things that to take care of. So for starters, what we are doing is we are making it objectively we're only ensuring objectively verifiable false, objective verifiable problems, and leaving subjective to kind of uh, to, to to when we mature and the risk management really becomes a thing, which I think at this point is not. In general, on the Oracle side of things, we definitely use oracles, not for this real world event things. We use oracles for price feeds, which is, I think, a much mature solution. We use Chainlink Oracle, that's one. We are also using some variation of Chaos Labs oracles as well. They have a Chaos Lab has an oracle solution. We are using that. And mostly most of this are used for price feeds. And yeah, and to like determine dynamic pricing of policies based on asset price fluctuations. And yeah, I mean that's my answer. But to also go back and like finalize this, the revolution is kind of very important. Like insurance is all about capacity, compliance, and efficient claims management process. And we are the goal of Catalysis is to minimize the number of hoops that you have to go through to actually find out if a payout is valid or invalid. Since we're starting with objective verifiable false, it's all good, but we recognize the limitations of this, because if you want to expand to more use cases, we might have to go beyond that, which is fine. But yeah, we are developing in-house kind of risk curation, like claims assessment uh, resources in-house. That's our plan to like go broad. And in general, that's on our side on Catalysis, but there's also something what we call veto slashing on the restaking protocol side, where you can, even if we say that, even if like if there's a wrong, if a claim went by through us of like, let's say claiming $50 million that was verified by us, but if there is a question about like whether this is valid or not, the base layer, the restaking protocol has something on veto slashing, where ultimately the restakers have a say and they can raise a veto request. They're like, hey, this claim should not be processed. At least should be looked twice. So we have that level of granularity today, but I think yeah, as risk management matures, we might have to, bring out this talent to do that. But yeah, I mean, look, I think Nexus Mutual is also doing this thing, but it's very opaque, is what my problem with that solution is. Because you don't really know. Like Max, if you're going to Nexus and saying that, hey, can you process my claim? And they sit in they'll take a request and come back to an email saying that, hey, your process requested, and you cannot question why. It's like it's
Yep.
a very subjective decision made by a committee, which I think, like, I don't really like that approach, but probably this is something that has worked. So, but yeah, we'll try to find alternate solutions.
Are you guys planning to introduce any Catalysis related governance token for capital based voting on certain disputes, or are you trying to stay as like unopinionated as possible as an application yourself and just work more as a background solution?
Yeah, for sure. One of our token advantages is to assist in governance decisions, which is again like disputes and bonds for coverable curators. So yes, we plan to have something like that. Although I would say this is going to be more in the midterm, not in long term, but not definitely not in the short term. The short term, we need more control and more authority on how we, shape this risk management policies across different cover pools, because that's super important. We cannot like mess that up. That's the entire lifeline of any insurance platform like Catalysis, or insurance marketplace like Catalysis. So, but as we progress, as we have more permissionless, where like we let anyone to create more cover pools, that's where like we start doing more, taking governance into place and taking it more seriously. But yeah, all in all, we have plans to introduce governance into these things, but I don't want to make it messy from day one. So that this might come in a later stage once the marketplace has matured to a point where it all starts making sense.
Very nice. Maybe to finish off, what does the current competitive landscape look like? I've heard one other protocol, I think it's re.xyz, come up in a few conversations I've had over the past weeks. Are they direct competitors of yours, or like how are you differentiating yourself from other projects in the DeFi insurance space?
Yeah, I honestly don't have enough context about RE7 or like the XYZ, though I have seen their website, but I did not get a chance to look into that. But definitely on the competitive landscape, the top player in the space, which we respect and frankly trying to work with instead of competing, is Nexus Mutual, just because they have gone through all those things and they have real expertise on. But that's the top player in the market as on-chain insurance is concerned, Nexus Mutual. The others, there's no other that I would worry about or think worthy of competition. As for RE.XYZ, I think from as far as I know, it's a different game. It's kind of doing reinsurance, taking like it's almost as private credit of sorts, or like private option, like option insurance, getting this option insurance premiums on chain. And they're doing that. I think they're doing pretty well as well. So not sure what they are. For on our side, we differentiate with REXYZ or Nexus Mutual on being more of a permissionless and very smart contract driven platform with objectively verifiable faults, and try to be as quick, as fast, as seamless of a product experience as possible. And we just want to fix the way on-chain insurance is kind of taken and viewed in the space, and just make it very seamless for everyone involved, from policy origination to claims processing to claims assessment to premiums. All of these things should happen without you knowing that things are going happening. So that's how I differentiate with these players. Although I think in the mid to long term, I definitely see the larger players from TradFi, the Munich Re and the Swiss Re's of the world coming into picture, which I'm excited about, because that's where like we will see real institutional insurance adoption on chain need, and that's where our edge would be, that we will be in the space, and so we would have developed a really nice risk expertise of dealing with on-chain insurance risk. And but again, those are the players that we think might be really interesting competition in the midterm. But short term, it's just us, Nexus Mutual, and a bunch of very small few players.
Very nice. Are there any other topics you'd like to dive into? before we finish off? Anything we've missed?
No, Max, I don't think we missed anything. It was really fun. We chatted a lot of different things from the journey of insurance to pricing, cover pool architecture, claims assessment, all the really good questions. I think we covered everything. All I would say is we are going to launch a pilot in, I don't know, 8 weeks or so. We'll see that. And we're going to launch a mainnet in Q1 next year. So if an institution, if you're like, hedge fund, VC, liquid fund, digital asset treasury, anything, and if you're an institution that is looking to deploy into DeFi or looking to access on-chain insurance or on-chain risk coverage, you feel free to reach out to me. I'm available on Telegram, on email, um, and we can chat through things. And I'm also happy to work with different DeFi protocols, leading DeFi protocols that are dealing with institutions, that have institutions as clients, and happy to integrate coverage solutions with all these protocols. And yeah, let's bring institutions on chain.
Very nice. Where can people find you? Where can they reach out if they're interested in getting coverage?
I mean, as far as the crypto ready folks go, they can reach out to me on Telegram. We can share that on the podcast link. And you can also email us at founders@catalysis.network, where we can respond to all queries. So you can reach out to me on Telegram. You can reach out to me on Twitter. I'm very active on Twitter, so you can reach out to me there. And you can find me traveling from New York City to all across Asia. So if you want to grab a coffee, just let me know and I'll fly out there.
Very nice. Are you going to be at DAS London next week too?
I wish, but I will decide this weekend, which is tomorrow.
Nice. All right. Was great talking. Abhi, was great having you on. I'll make sure to put all the links to reach out to you in our podcast description. And yeah, I hope that DeFi insurance as a whole will succeed, because I consider it a very essential part to, in the process of our space maturing and serious capital and serious longer lasting opportunities being provided for both investors, curators, and users, and everybody else who's a stakeholder in on-chain finance. Yeah, was great having you on, and maybe see you in London next week.
Thank you so much, Max. You have been an amazing guest, and yeah, looking forward to doing more of this in the future. Thank you so much. Appreciate it.
Very nice. Thanks everybody for tuning in.